Navigating property or mortgage changes can be a headache, but it doesn't have to be. Today, my quickfire guide will explain exactly what you need to think about when reassessing risk at key milestones within your property journey. First and foremost, we're going to go back to the goals. Your short, your medium, and your long-term goals. Every 12 months, these should be reviewed to make sure that your final destination is still being achieved by your short, medium, and your long. At this point in time, you've probably already transferred risk. What I mean by that is that you've insured your assets and yourself. So a few key milestone moments to think about when these need to be rediscussed. The most common one that I get is, what do I need to consider at Refix or when I do a restructure? The first thing when it comes to property, we need to make sure that the property is still insured for the same amount of value. During your period of 12 months, if you've done renovations or you made some changes, you might have insured your property for less than what it's actually valued at today. We're now talking about the dwelling. There are websites that will tell you exactly what you need to do here, so I encourage you to go and have a look at that every 12 months to make sure you're not overpaying or underpaying. The second one is the change in risk. If you brought in some tenants, for example, into your property, making sure you've got landlord obligations all covered, that being the likes of meth contamination, it might also mean intentional damage. Make sure you've got the right bells and whistles for your policy if that's you. When we talk about yourself, looking at your health and your income and your debt position. Every year, ideally, your mortgage will start to go down because you're paying it down faster. If that's the case, your life insurance may well still be insured to an amount that you aren't needing any more. A lot of the time, this does happen. Premiums typically go up, cover goes up, but debt goes down. Why? Why do we not make sure that these are staying in line with your current situation? That's the number one thing that I always speak to my clients about. The second one is probably looking at the value and the value quality, and that is what we talk about when we get claims paid out. We want to make sure the quality of the cover as well as the value are aligned. Not all insurance is made equal. It's not equal at all. So making sure that the right policy in place for you is actually fit for purpose. One really cool tip is that if you have gone down the route of the offset facility or a revolving credit, we can actually utilize that as your emergency fund. You retain that, and in such, some of your income protection or your premiums can actually drop in cost. So if that's you and you haven't even considered that, that's a real tip to get in touch with somebody to discuss. Now, the second sort of milestone that we see a lot of the times is that you've been able to go down the route of refinancing to potentially get a second property. On the property insurance front, one of the things you need to make sure, and I talked about it a little bit earlier, is making sure that you've actually got the right bells and whistles. Landlord extension cover, so that your risks are actually covered. Making sure meth contamination is covered. Intentional damage is covered. Making sure that you're doing what you need to protect your dwelling. On your personal side of things, what I see a lot of people do is get put into a blanket space. What I mean by that is that if your debt increases, people just say, look, you've got to increase your life insurance to match the debt. Not always true. If you're in a situation where your property is now going to be cash flow, we need to take those things into consideration. You might be in a position where your owner-occupied mortgage is covered if either of you were to pass away, but you don't need to make sure your investment one is covered as well, because that's positively geared, and that's because you've actually got some advice and purchased the right type of property. We also want to make sure that we're talking about the knowledge. All right, so when you buy the right type of property, we want to make sure you've got the right type of insurance to make sure that's all covered all the way through. The last one is a really interesting one. It's all about being a business owner. Now, business owners have a lot of different responsibilities and a lot more to think about when it comes to public liability, your own personal liability. This is an area that you really need some advice in, guys. What I see a lot of the time is people going out, want to make more money, whether it be in the trades or whether it be in a shop, but they're not actually insuring the things that make them the money enough. Going direct isn't going to be the answer here. There's going to be limitations. So my number one bit of advice here, go and seek advice if this is you, and make sure that everything is up to scratch, because tools and plant and shops 12 months ago or 24 months ago are going to be valued slightly differently now if you need to replace them. And lastly, what do you need to consider if you're one of these people that do own a business either on your own or with somebody else? If it's with somebody else, make sure your buy-sell agreement is all up to date if you have one. In short, what the buy-sell agreement does is in the event you pass away or you are unable to work ever again, it allows your business partner to buy you out of the business so someone else can't come in. There are two types. The first type is either the valuation is done at market value. If that's the case, every year you need to review this, or it's in an agreed value. You guys might have decided what you want that to be. It's completely fine. Still needs a review with your lawyers. The second one is the key person. If you or somebody within your business is a key person to generating revenue, if that person steps out due to illness or injury, how are you going to replace that revenue? Right, we really need to think about the foundations of your business, where it derives its income from, and if those sources disappear, are you still going to have a business? Is your net profit still going to be there? Is your gross profit going to be able to or your gross income, able to ensure that all your debts are repaid? That's something really, really important. Now, the other aspect here is all about cost, right? We understand things go up and they come down. Just making sure that your business insurance, whether it be on your tools or your liability, or if it's on your key person and your business stuff, making sure that you're actually getting good value for money, but you're not sacrificing quality just to get the cheapest price. The number one thing. But again, get advice. The last thing I could say here, surround yourself with the right team. If you're sitting in this category, you want to make sure your insurance advisor, your KiwiSaver advisor, your mortgage advisor, your business advisor, if you have one, your accountant, that you're all speaking together and you're on the same hymn sheet. If one person doesn't know what the other one is doing, it can lead to really big gaps and errors in this whole space. So make sure that you're dealing with the right people, the right team, make sure it's updated consistently. And I understand they're not discussions you want to have all the time, but really important to making sure you're going to achieve your financial goals.
Financial freedom.